Okay, I hope we are all doing well.
Yes, sir.
Okay, that is fine. So we thank God for another day like this. And as usual, we are still in the ICAG examination preparation week. So whatever happens, whether you are fine or not, since you want to write the exam, you have to take your phone and join every Saturday in the morning so that I will come and tell you things that you know but you are not aware of. Okay. So this morning we are going to continue our discussion with the financial accounting reporting standards, the international financial reporting standards. Okay. Today we are going to, or this morning we are going to look at two simple standards, which mostly might be in financial reporting exam, but it can also appear in the corporate reporting exam. It can also appear in the corporate reporting exam. Okay. These two standards that we are coming to look at is what we call the IS10, which is the event after reporting dates, and also the IS8, accounting policies, estimates, and errors. Okay, so we look at the event after the reporting date first. The event after the reporting date first, which is the IS10. All right. So mostly what happened is that financial statements or statement of profit or loss, statement of changes in equity, statement of financial position, statement of cash flow, all these statements are being prepared at the end of the reporting period. At the end of the reporting period. But after the financial statements are being prepared, they will be given to management. So management will now have a board meeting or a meeting, discuss the issues before they will now what sign the financial statement. Then it will be published. So after the financial statement is being prepared by the financial accountant or the accountant, it will not be published at once. No, it will be sent to management, so they will consider it, consider some of the items, look at it, deliberate it on it before management will finally sign the financial statement. So it means that from the day that the financial statement was prepared to the time that it will be published or it will be authorized for issue, there will be some days within the reporting date and also the date that the financial statement will become public. All right. What normally happens is that after the financial statement has been prepared and they are being given to management to deliberate on, there might be some issues. There might be some financial issues that might happen within that particular period. So if those issues arises, or if those issues arise, or if those issues come into play, what do we have to do to our financial statement? Is it going to affect how the financial statement is being prepared? Is it going to affect some items in the financial statement? If that should be the case, then what should we do? Should we now re-prepare our financial statement, or we should just give a disclosure about this event that happened after the reporting date? So that is basically what the event after reporting date is trying to address. So from the time that the financial statements are being prepared to the time that they are authorized for issue, the event that happened within that period, what should we do? Should we adjust our financial statement to reflect those items, or we should just give a disclosure? If you are giving a disclosure, what should we give the disclosure about? We should give disclosure about the nature of the item and also the amount involved. So the event after reporting this is just talking about those events or those transactions that occur between the reporting period and the time that the financial statement or the financial statements were authorized for issue. Authorized for issue means that they are officially signed and it will be published. It will be made in the public domain. That is what we mean by the authorized by issue. So basically, the event after reporting date, the main objective is that they want to see whether we should adjust the financial statement to reflect the items that happened after the reporting period before the financial statement were authorized for issue, or we should give a disclosure to those particular items. That is the main objective of the IS10 events after reporting date, whether we should adjust our financial statement or we should give disclosure to items that happen after the reporting period, but before the financial statement were authorized for issue. All right. With this, the standard gave two form of what events. The standard gave two form of events, and the first one is adjusting events. The standard define or try to outline two types of events. We have the adjusting events. We have what we call the adjusting events. Adjusting events and no adjusting events. Adjusting events and no adjusting events. Okay, so the events, any event that is going to happen after the reporting date, but before the financial statements were prepared or were authorized for issue, will be classified as adjusting event or no adjusting events. What are the adjusting events, or what event do we call adjusting events? Okay, the adjusting events might be like, you see, during the year, a customer is owing the company. You have receivables. During the year, you have receivables. During the year, you have receivables. After the financial statements were prepared or after reporting date, you receive a notification that this particular customer has gone bankruptcy. So there is no way that particular customer is going to settle his part of the debt. In that case, what is going to happen is that you have a bad debt. But these bad debts, you have the customer's figure during the year. The customer was owing during the year. So after the financial or after the reporting period, they are now telling you that this particular customer is out of business. Is out of business. So what do we do? What do you do? Do you have to go and make provision for that doubtful debt, or you just leave it and give disclosure? If you don't make or if you don't adjust the receivables, it means that you are overstating your receivables. You are overstating your receivables. And another issue is that the customer has been there from the beginning of the year. The customer has been there from the beginning of the year. Now, after the year end, they are now saying that that particular customer might not be able to pay again. So what will happen? The receivables that you are having over there is not the actual receivable. So what do you have to do? Do you have to go and adjust the financial statement, or you should just give what? A disclosure about that particular item. If you give a disclosure, the meaning is that your financial statement is not what? Faithfully what? Represented, because you are overstating your receivables. In actual sense, the receivables has been there during out the year. So it's just like at the reporting date, these people might not be able to pay, or the company failed to make provision for doubtful debt at the reporting date. Another one is there's a court case against the company, and the issue is at the court. They are here to determine the amount of damages that the company will be paying. They are here to determine the amount of damages that the company will be paying. So at the reporting date, the company has actually settled the debts now. What do you have to do? Do you have to go and adjust our financial statement or not? These are the issues that we will be looking at. Yes, senior.
Good morning.
Yeah, senior.
Please, I want to know something. So suppose where the financial statements, or what that you are, the adjusting event is whereby from January to December we have closed our account, but the event that's happened after that December, before the account will be published, that is the adjusting event, right?
No, please. The event that will happen after that period is still adjusting or not adjusting event, depending on the nature of the event.
It can be adjusting or not, but depending on the nature of the event.
Yes.
Okay.
So
okay.
if there is an evidence, at the reporting day that this actually exists before the reporting period, like the settlement of the court case.
Yes.
Yes. So there was an evidence at the reporting date that, okay, this particular event was there.
Good.
So if that happened, that would be an adjusting event because the event was there throughout the year, but just that we didn't settle the amount. Example
Yes.
is the settlement of the court case. And also
Okay.
the provision for the doubtful debt. The customers figure were there during the year. At the end of reporting, they are now saying that some of the customers are out of business. So we
Oh,
make
okay.
provision for that particular one.
Oh,
But
okay.
after the reporting period, it might be like your warehouse got burnt. There was fire outbreak there. You see, throughout the year, you don't have any evidence that there will be a fire
Yes,
outbreak at
it's
the end of
true.
the year.
It's true.
So these issues that arises after the reporting date are the non-adjusting events. Those that there is no evidence of their happening at the end of the reporting date. Those are what we call the non-adjusting events. And also the
Okay.
acquisition of a subsidiary. If you acquire a subsidiary throughout the year and there was no agreement within the year that you are going to acquire this subsidiary, there is no evidence during the year that we are going to acquire this subsidiary. But if there was an agreement going on during the year that there will be an acquisition of a new subsidiary, then we can say that that is an adjusting event because there was an evidence during the year that we are going to acquire a new subsidiary because agreement was going on within that particular year.
Okay.
So the
Okay. So
event.
let me ask further again.
Okay.
What about if, like, at the day of December, we jump into a agreement. We jump into some agreement to buy a company.
At the reporting date.
It's within this reporting day, but it's the 20th of December, whereby the account will close at 31st December.
Yeah, that is still an evidence.
Oh, okay.
Unless it is happening at the reporting date.
Okay.
If it is at the reporting date, then the agreement will start the beginning of the subsequent year.
Okay. That one become non-adjusting event.
No adjusting event. So
Okay.
every event after reporting date can be adjusting or not adjusting, depending on how the issue happens. So the standard defines adjusting event as they provide evidence of condition that existed at the end of the reporting period. Financial statements should be adjusted for adjusting events.
Okay.
So if you look at the event, there will be an evidence. You can confidently say that, okay, there was an issue like this. There was an issue like this within the year. The first example is the settlement of the court case.
Yes.
There was a court case within the year, but just that we don't know the amount that we are going to pay for it. So after the reporting date, we have settled it. So we have to make provision for it. Another one is bad debt. The customers' figures were there. The customers are owing us during the year, and we have it in mind that it is likely that some of them they might not settle the amount. So at the end after the reporting period, but before the financial statement were authorized for issue, after the financial statement is being signed, there is no way you can do anything again. So before the financial statement will be authorized for issue, you realize that some of the customers are out of what? Business. The assumption is that the company fails to make provision for doubtful debt at the end of the year. So you just have to make the provision now to reflect that. Another one is also if after the reporting date, the company sold its inventory below its carrying value. It means that there was an impairment of the inventory at the reporting date. So reduction in the carrying value of an inventory is also an adjusting event. It's also an adjusting event. And also fraud. If there is an issue with fraudulent acts, the company is saying that their customers are owing them 50,000. Meanwhile, the financial accountant has taken 2,000 from them, but fails to what? To report the 2,000. Okay, the 2,000 was taken during the year, but just that we are not aware. But after the reporting date, we have discovered this particular fraud. Fraud should also be what? Adjusted for. Or fraudulent acts is also what we call an adjusting event. Impairment of an asset. Impairment of an asset should also be seen as an adjusting event. So I've given some examples of adjusting event over there. The sale of inventory after reporting date, this gives evidence about the net realizable value of the inventory at the reporting date. So if you sell inventory below its carrying value after the reporting date, it means that the actual net realizable value of the inventory at reporting date is the value at which you have sold the inventory. But if the inventory is being sold above its carrying value, we don't do anything. We don't do anything because the meaning is that is the carrying value is the actual value at the reporting date. The bankruptcy of a customer, this confirms the allowance is required against the receivable balance at the reporting date. So discovery of fraud and all those things will be adjusting events. So the company will adjust for them. So if you see, they will give you, mostly it will be in a theory form. They will give you about 4 items. Then they'll ask you to explain whether they should be adjusted or not. You should be able to identify whether this particular event, there's an evidence or there was an evidence during the year. There was an evidence during out the year. So adjusting events provide evidence of conditions that existed at the end of the reporting period. They provide evidence. They provide evidence of events that existed at the end of the reporting period. The standard also define what we call non-adjusting events. Non-adjusting events. The non-adjusting events, they are conditions that tell us that these things are happening after the reporting date. They just give us condition. There is no evidence. They're just saying that these things, they arise after the reporting period. They happen after the reporting period, and we cannot use any evidence to back them. We cannot use any evidence to back them. So they indicate conditions that arose after the end of the reporting period. They are not adjusted for in financial statement, but are disclosed. But not all of them will be disclosed. It depends on the nature of the event. If the event is going to jeopardize the future operations of the company, is going to affect the going concern concept, or is going to affect the operations of the company, or if the event is similar to the operations of the company, then the users of the financial state will be interested to know that this particular event happened. So if there was a fire outbreak and some of the inventory got burnt, the cost involved, if the cost is that much, then you have to disclose it that after the end of the reporting day, this thing happened and this is the amount. But if the thing is not going to have any effect on the future operations of the company, you can decide not to disclose it. You can decide not to disclose it. You can decide not to disclose it. Disclosure for non-adjusting events. Non-adjusting events after the reporting date are treated differently. A non-adjusting event relates to conditions that do not exist at the end of the reporting period. Therefore, the financial statement must not be adapted to include the effect of the events. IS 10 states quite firmly, an entity shall not adjust the amount recognized in the financial statement to reflect non-adjusting events after the reporting period. However, IS 10 goes on to say that if a non-adjusting event is material, we are talking about the money, and we are talking about how it is going to affect the economic decisions of the users. Is it going to affect the economic decisions of the users? If yes, then we should give a disclosure. Failure by the entity to provide a disclosure about this could influence the economic decision taken by the users of the financial statement. For material non-adjusting events, IS 10 therefore requires disclosure in notes of the financial statement of the nature of the event and also the amount involved. So there was a fire outbreak, that is the nature and the amount involved. Examples of non-adjusting events. The first one is a major business combination after the reporting date or the disposal of a major subsidiary. So if there was no agreement during the year that the company is planning to dispose its subsidiary, but the thing just happened after the reporting date, no, there is no evidence. So in that case, the financial statement will not be what? Disclosed, or will not be adjusted. But we look at the amount involved in the disposal, then we'll now go and give a disclosure about that particular event. Announcing a plan after the reporting date to discontinue an operation. So after the reporting date, the company is now trying to do a restructuring. They are now announcing the restructuring. But if the restructuring was announced during the year, but after the reporting date, you have carried out, there was an evidence that it is likely that the restructuring might take place within the year. In that case, we can adjust the financial statement for that particular event. But if there is no evidence, there is no evidence to prove that this was actually in place during the year, and the thing just happened after the reporting period, that particular item should be seen as a non-adjusting event. Major purchases and disposal of assets after the reporting period. There was no negotiation, there was no agreement, there was no plan to dispose. No, it is a non-adjusting event. Announcing or commencing major restructuring after the reporting date is just like announcing to discontinue. Large changes after the reporting date in foreign exchange rates, equity dividends declared or proposed after the reporting period. We will come to dividends, where dividends will be treated as an adjusting event and where dividends will not be treated as what, or dividends will be treated as non-adjusting events. Okay, if there is a change in government law after the reporting date, there's a new tax rate, we don't treat the changes in the tax law as adjusting events because there was no indication, there was no evidence during the year that there will be a new tax rate. So you can have a question that you'll be giving a new tax rate, use the old tax rate because the new tax rate will be seen as what? A non-adjusting event. Another one is also a revaluation of an asset. There was a revaluation of the asset and the company was not using a revaluation model. If there is a revaluation of the asset after the reporting period, that will also be seen as a non-adjusting event. Let's come to dividends. Okay. If the company proposed the dividend or declared the dividends after the reporting period, then that particular dividend will be seen as a non-adjusting event. But if the company's financial year is January to December, okay, in October, the company proposed a dividend and the dividend was declared after the reporting date, okay? There was an evidence that the company is likely to pay dividends for the year. So the dividend was proposed within the what? The financial year, but later declared after the reporting date. So if the dividend was proposed during the financial year, that gives us an evidence that dividend might be paid after the reporting period or at the end of the reporting period. So after the reporting period, if the dividend is being declared, the dividend will be treated as an adjusting event because there was an evidence during the year that dividends might be paid at the end of the financial year. So if the dividend was proposed before the financial year, the dividend after or the dividend paid or the dividend declared after the reporting period should be treated as what? Adjusting event because it was proposed during the year. There was an evidence that dividends might be paid at the end of the year. So if equity dividends are declared after the end of the reporting period, they should not be recognized as a liability in the statement of financial position because they do not exist as an obligation at the end of the reporting period. Dividend proposed after the end of the reporting period should be disclosed in a note to the financial statement in accordance with presentation of financial statement, that is the IS1. Okay, but if the dividend was declared or was proposed before the financial year ends, that particular payment of the dividend should be treated as adjusting events. Let's come to some of the issues that will be a non-adjusting event, but it will affect the going concern of the company, or the company is now saying that they are going to cease operation immediately after the reporting period. So the year is January to December. So the company is saying that, okay, after the December, they will not operate again because the company will not be there again. They are going to liquidate the company. In that case, every event that will happen after the reporting date, whether it is adjusting or not adjusting event, all of them will be adjusted because the company is going to cease operation. So we have to prepare our financial statement on what we call breakout values. So whether the issue is an adjusting event or no adjusting event, they should all be treated as what? An adjusting event if the company is going to cease operation immediately after the reporting period. But if the company will still be in operation, it means that the non-adjusting event will be adjusted against the subsequent year financial statement. But if the company will cease operation after the reporting period, then it means that there won't be any items that we are going to adjust the non-adjusting event against. So in that case, we should treat all the event as what? Adjusting events. Adjusting events. All right. There is an exception to the rule that financial statement reflect conditions at the reporting date. If after reporting date, management decides to liquidate the entity or cease trading, or decide that it has no realistic alternative to these actions, the financial statement cannot be prepared on going concern basis. In accordance with IS1, management must disclose any material uncertainties relating to events or conditions that cast significant doubt upon entity's ability to continue trading. This applies if the events have arisen since the reporting period. The going concern assumption is no longer appropriate. The IS10 states that a fundamental changes in the basis of accounting is required. In this case, entity will prepare the financial statement using the breakup basis. If the financial statements are not prepared on going concern basis, the fact must be disclosed. The fact must be disclosed. So all that I have said is what we are trying to say. If the company can no longer foresee the future operations of the company, then the financial statement must be prepared based on breakup base or breakup values. We treat every event after as events which is an adjusting event. So you look at the disclosures over there and we take that example. Let's take like 2 or 3 questions and move on to the changes in accounting policies and estimates. Let's take the example there. Data is an entity. Let's take that one. Auntie Eunice, are you there?
Yes, please. I'm looking for the question.
Okay. Example after the disclosure.
Okay. I didn't see it.
Okay, let me read.
Okay.
Delta is an entity that prepares financial statements to 31st March each year. During the year ended 31st March 2002, the following event occurred. A. At 31st March 2002, Delta was engaged in a legal dispute with a customer who alleged that Delta had supplied faulty products that caused the customer actual financial loss. The directors of Delta considered that the customer has a 25% chance of succeeding in this action, and that the likely outcome should the customer succeed is that the customer would be awarded damages of $1 million. The directors of Delta believe that the fault in the product was caused by the supply of defect component by one of Delta's suppliers. Delta has initiated legal action against the supplier and considers there is a 70% chance Delta will receive damages of $800,000 from the supplier. Ignore discounting. B. On 10th April 2002, a water leak at one of Delta's warehouse damaged a consignment of inventory. This inventory had been manufactured prior to 31st March 2002 at a total cost of $800,000. The net realizable value of the inventory prior to the damage was estimated at $960,000. Because of the damage, Delta was required to spend a further $150,000 on repairing and repackaging the inventory. The inventory was on 15th May 2002 for proceeds of $900,000. Any adjustment in respect of this event would be regarded by Delta as material. Required. Discuss how these events would be reported in the financial statement of Delta for the year ended 31st March 2002.
Okay. So this one is not actually talking about events after reporting date. The first one is not actually talking about events after reporting date, but the second one is talking about what? Events after reporting date. Okay. So we are saying that at 31 March 2X2, Delta was engaged in a legal dispute with a customer who alleged that Delta has supplied 40 products and this and this. So this is about provisions, IS 37. Okay. If we call something a contingent liability, okay, you can see that the Delta will be paying for the damages if the court says that they should pay. So the liability is an obligation that is dependent on a particular event. And the event over here is the what? The declaration of the court. But this one, the lawyers are saying that there's a 70% that chance that what? The customer will be succeeding, the case will be succeeding, or the customer will be winning the case. In this case, what is the meaning? It means that Delta is automatically losing the case, isn't it?
Yes.
Okay.
Yeah.
So therefore, okay. So therefore, the debtor should be making a provision in regard of that particular what amount. But the question now is, what is the estimate that the lawyers are giving to Delta? They are saying that the customer will be getting what? Will be getting $1 million or $1 million in return for the damages. Okay. The directors of Delta further believe that the 40 in the product was caused by the supplier of defect components by one of what? Delta suppliers. Delta has initiated a legal action against the supplier and consider there is a 70% chance that Delta will receive 800,000 from the supplier. Ignore what? Discounting. So the first one is at the reporting date, we should make provision. We should make provision of 1 million, which is a liability, because it is possible that the customer is going to succeed or the customer is going to win the case. So Delta will be paying. So Delta has to make provision for that future obligation. That will be 1 million. But if it is clear that Delta will be losing their case, but there is no a reasonable estimate, we can't make provision, because even if we make the provision, what amount are we making the provision for? So we only disclose if there is no reliable estimate. But this one, there is an obligation, likely that the customer is going to win, and it is clear that Delta will be losing the case, because 70% chance that you are going to pass the exam, it means that you have passed the exam. So we should make provision for that particular damage. But here is the case, Delta is also claiming that the fault was caused by what? One of their. Sorry for that. So here is the case, Delta is also claiming that the fault lies with a supplier, and they are going to receive what? 800,000 from the supplier. But who is telling Delta that they are going to receive the what? The 800,000 from the supplier? Who is advising that it is likely they are going to receive that? Is the advice coming from a lawyer, or is their own belief? Is the advice coming from a lawyer? The claim, is it coming from a lawyer?
No.
It's not coming from a lawyer, isn't it?
Yes.
Yes. So if the advice is not coming from a lawyer, this is an asset. the advice is not coming from a lawyer that there's a 70% chance that you are going to receive the 800,000. They know what they are talking about because they are going to defend you and they know that they will do everything for you to win the case. But you are estimating that there's a 70% chance that you are going to receive this money. No. Your estimate has no what? Legal proof. So in this case, this is a contingent what? Asset, but you cannot recognize it. You can only disclose it because the possibility that you are going to receive this money is not certain because you are making the estimate. The estimate is not coming from a legal person. So debtor will make provision for the 1 million, but they will disclose the what? The contingent asset of the 800,000. If they are able to receive the 800,000, fine, they recognize it. But if they are not able to recognize, they are not able to receive it, fine. But if the 800,000 claim is coming from a lawyer, it's a lawyer that is telling them that, okay, there's a 70% chance that they are going to receive 800,000. It means that they are going to defend them to get the 800,000. In that case, Delta can recognize alternative what? Contingent asset as against the contingent liability of the 1 million. Or sometimes the supplier will tell them that, okay, we are going to compensate you with any amount that you have spent. We are going to compensate you with any amount that you have spent in settling the legal case against you by the customer. So in that case, if the supplier is giving an assurance that they are going to refund any amount that they spend, in this case, Delta can make an equal reclaim provision or contingent asset of 1 million because there is an assurance that they are going to receive that money back. But if there's no assurance, then provision should not be made for the contingent assets, which is the 800,000. But that will be for the provision for the damages, which is 1 million, will be made at the reporting date. That is the A. Let's come to the B part. Okay, on 10 April 2X2, a water link at one of the debtors' warehouse damaged a consignment of inventory. This inventory had been manufactured prior to what? 31 March 2X at a total cost of 800,000. The net realizable value of the inventory prior to the damage was estimated at 960,000. Because of the damage, debtor was required to spend a further 150,000 on repairing and repackaging the inventory. The inventory was sold on 15th May for proceeds of what? 900,000. Any adjustment in respect of this event will be regarded by debtor as what? Material. All right, so let's come here. Let's come here. Should this event be adjusted?
No,
Why?
because no condition of water leakage existed before or during the reporting period.
Okay. No. Yeah, you said no what?
I said no evidence or condition of water leakage existed during the reporting period.
Okay. So what happens to the sale of the inventory?
The inventory sales even happened, I think, somewhere around May, which is after the reporting period.
Maybe before the financial statements were authorized for issue.
Yes, so with this, I think it will mainly be disclosures because one, the event that caused this issue did not exist during the period. And secondly, all other damage control and occurrences happened after
the reporting date. So a disclosure will be appropriate than adjusting.
Okay. 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 Okay.
Sir, please have a question.
Yes, please.
The question gives us the reporting dates, but then how do we determine when the financial statements were issued to the public? Or yeah,
I didn't hear your question. Oh.
I'm asking that in the question we'll be given the end of the financial year, which is 31st March 2002.
Okay.
But then how do we know the date when the financial statements were published
Okay.
before maybe we can determine that this would be maybe a disclosure or non-disclosure event?
They will always give you the date that the financial statement will be authorized for issue. But if you are not given every item given to you or every event given to you, you should assume that they happen after the reporting date, but before the financial statement will be authorized for issue.
Okay. Thank you.
Okay, Michael.
Yes, sir. So I have a different opinion to that of my brother, what my brother just said. So my opinion for the question B is that we are looking at the inventory, the damage to the inventory. And the inventory happens to be an evidence in the financial statement, but cause damage after the reporting date. So it means that since there's a damage to the inventory, the said inventory needs to be adjusted.
But
in
the
the
question,
financial statement.
but the question is, what is causing the damage?
Is the water leakage.
So
The water leak.
if not for that particular water leakage, would there be a damage?
No, there wouldn't be a damage.
So we look at what is causing the damage.
Mm,
We look at what is causing the damage. But if
okay.
they are just telling you that at the end of the year, the inventory was sold for this amount, now that is where you determine whether the inventory was sold below its carrying value. But in this case, it is the water leakage that is causing the what, or that is causing the damage. So we pay attention to the thing that is causing the damage than the inventory itself. Although you consider the inventory was sold at a price lower than that particular amount, isn't it? At a price lower than the carrying value. You can see that they have given you the net realizable value of the inventory prior to the damage was what estimated at what 960. It means that if not for the water leakage, the inventory will not be anything because the net realizable value is higher than the carrying value of the 800,000. So as at the reporting date, the inventory was in a good shape. That is why the net realizable value is higher than the carrying value. So you can see that they say prior to the damage, the net realizable value of the inventory was 960,000. Was the carrying value or the cost was 800,000. It means that the inventory was in a good condition at the end of the reporting date. But the damage to the inventory now is mainly due to what happened after the reporting date. So we pay attention to what is causing the damage. We pay attention to what is actually causing the damage. So the question says that any adjustment in respect of this event will be regarded by debtor as material. Therefore, disclosure should be given about the inventory. Disclosure should be given about the inventory. All right. So, Senior Michael, I hope you are okay with that side.
Yes, sir. Yes, sir. I'm
Okay.
okay.
Okay. Let's take additional 2 questions. Let's take tutorial question 3.
The directors of ZPLT declared that a dividend of $1 per annum shall be paid to shareholders on the company's register register as of 15 April 2014. Financial statements were approved by the company's board on 30th May 2014. The shareholders at the company's annual general meeting held on 15 June 2014 approved the payment of the dividend to eligible shareholders on 1st July 2014. Required. Explain how the dividend proposed by the directors should be treated in the financial statement XYZ PLC in accordance with IAS 10.
So this one we need to, okay, one problem with this one, we need to know the reporting date. Okay. We need to know the reporting date of the entity. Share to be paid to shareholders on the register as at 15 April. The financial statements were approved by the company's board on 30th May 2014. The shareholders at the annual general meeting held on 15th 2014 approved the payment of the dividend to eligible shareholders on 1st July 2014. So this one, we don't know the reporting date. So what you have to do is that your response should be a general one. Your response should be a general one because we don't know the reporting date of the entity, but we know when the dividend was declared. We don't know whether the reporting date is 31st May or is 31st March. We don't know. They have not given us information on the reporting date. So your answer to this particular question should be a general one. General one in a sense that if the dividend was declared before the reporting date, then the payment of the dividend should be treated as an adjusting event. But if the declare of the dividend of 1 cedi per ordinary share was done after the reporting date, then it should be treated as well, non-adjusting event. And necessary disclosure should be given in that effect. So that's how you are going to answer it because you are not giving the reporting date. You see, you are not giving the reporting date. This is an open statement. So you just answer it the way you know it. If the dividend was declared before the reporting period and was paid after the reporting period, then there was an evidence that dividend will be paid at the end of the year. Therefore, the dividend payment should be treated as an adjusting event. But if the dividend was declared after the reporting date and paid after the reporting date, then it should be treated as non-adjusting event and necessary disclosure should be given in that regard. All right. Let's come to question number 8. Let's look at the question number 8.
The following events occurred after the year end, but before the following events occurred after the year end, but before the financial statements were authorized for issue. 8. The company publicly announced a plan to reduce the workforce by 10% as a result of worsening economic conditions. B. Fire completely destroyed the company's largest warehouse and the inventory it contained. The carrying amount of the warehouse and the inventory were 10 million and 6 million respectively. It appears that the company has not updated the value of its insurance cover and only expects to be able to recover a maximum of 9 million from its insurance. The company's trading operations have been severely impacted since the fire, and it expects large trading losses from time to come. A single class of inventory held at another warehouse was valued at its cost of 160,000 at the year end. Just after the year end, 70% of this inventory was sold for 280,000, on which the company's sales staff earned a commission of 15% of the selling price. B. The notification of the bankruptcy of a customer. The balance of the trade receivable due from the customer at the year end was 23,000, and at the date of notification, it was 25,000. No payment is expected from them. bankruptcy proceedings required in accordance with IAS 10. Events after the reporting period. Explain the justification whether each of the above is an adjusting or non-adjusting event after the reporting period.
All right. So let's take the first one, the A. So you should explain whether it's an adjusting event or no adjusting event. The A. Adjusting or no adjusting.
It's non-adjusting.
Non-adjusting.
Okay. The question states that explain with justification. So no adjusting. What explanation are you going to give in that regard?
Okay, so because there is an indicative of condition that arose after the reporting period, which is the announcement, the public announcement to reduce the workforce by 10%. It shows that these are a non-adjusting event. So it means that it will be disclosed in the note of the financial statement by the nature of the event and the estimated amount of the financial effect. So probably the nature of the event, which is the announcement, the worsening economic condition, and an estimate of its financial effect, which will be the 10%. So that is my own explanation.
Okay, thank you, Senior. HP. HP, you wanted to talk.
No, I think I've lowered my hand because of it. His comments is similar to what I wanted to say. But all in all, it's just an announcement that is made.
Okay.
So they only need to disclose it at the.
Okay. 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 That is nice. Any other?
No, that's all.
Any other take on that?
Could somebody argue from the point that worsening economic conditions existed before the announcement, which came after the year end?
Yes. Someone wanted to say something.
Hello?
Yeah.
I'm asking that can an argument be made from the angle that the worsening economic conditions existed before the year end?
Yes, the Western economic, it existed before the year end, and also it might not exist before the year ends. So you don't have enough information to see whether it is existing before the year ends or it is after the reporting period.
Okay.
Okay. So the question now is if you should be there before the year ends, then it means that the announcement must be made earlier. They should have given notification that based on this thing, we are going to do this. So it means that after the reporting period, they have now decided to reduce the workforce. It is after the reporting period that they have decided to reduce the workforce. So what will happen is that we can say that there is no evidence of the announcement. There is no evidence of the announcement during the reporting period. The announcement comes in after the reporting period. So there's no evidence. It's one of those events that arose after the reporting period. So it should be a non-adjusting event. It should be a non-adjusting event, and disclosures about the nature and also the reliable estimate of the amounts should be made if this will be a material or is going to have a material effect on the operations of the company. Let's come to B.
Linux.
Yes, please.
So I mean, the announcement was actually made after the year end. That's what the question says.
Yes.
What if management had decided to maybe cut costs because of the worsening economic conditions, and so had cut this cost way before the statement has been issued and or authorized for issue, and just making the announcement because maybe they have gotten the approval from shareholders now?
If that is the case, then the question should have gone ahead to tell us that in the absence of all these assumptions, it is a non-adjusting event. Okay. but you can only make provisions. IS 37 was specific on that. You can only make provisions when you are committed to the plan to carry out the provision. You have also informed those who will be in what? Those who will be in, or those who will be affected by the decision. So the time that you are making the announcement, specify that is the time that you want to start carrying out what? The operation. So if you really committed to this particular one, you should have made the announcement to people earlier and now go to management to seek approval. So the announcement will be made that, okay, we want to, it is likely that we are going to reduce the labor force by this. So the announcement will be made. It means that we are committed. So if you receive the approval from management after the reporting period, then the announcement, the cost that we are going to incur should be treated as an adjusting event. But here is the case, the question was just straightforward that the announcement was made after the reporting period. There is no indication that it was made during the year. If announcement should be during the year, then we treat this as an adjusting event. Okay.
Yeah, I agree with your explanations, but if you look at the required in accordance with IS 10, explain with justification. So if I have justification, I mean the question looks like it's a general question. You do not even provide a reporting period date and all those things.
No, the following events occurred after the year end, but before the financial statements were authorized for issue.
Okay. So if I have justification that all of this happened, then I could explain that this was done prior, and so this will be adjusted.
Yes, please.
Okay, thank you.
Rich.
Yes, sir. Following up from the question my brother asked, assuming all the conditions he stated existed, how would they be treated?
Adjusting events.
Yes. How would the adjustment look like?
The adjustment will be, you determine the cost of the provision. I mean, you are going to pay some people redundancy fee and those kind of things. So you determine the cost relating to what? To the adjustment, to the restructuring. Then you make provision for it. The provision will first be treated as an expense and it will be treated as a liability. So you go and adjust your profits, and also you now have a new liability.
Yeah.
Okay.
All right. So the only way that you can notice an adjusting event is that the issue should give you a condition that was existing before the financial year ends. If you have anything to back that particular, as an evidence of that particular issue being there, then it should be an adjusting event. But if there was no evidence and the thing just happened after the year end, there should be no adjusting event. Any other before we move on to the next item, which is a B? The B, fire completely destroyed the company's largest warehouse and the inventory it contained. The carrying amount of the warehouse and the inventory were 10 million and 6 million respectively. It appears that the company has not updated the value of its insurance cover and only expect to be able to recover a maximum of 9 million from its insurers. The company's trading operations have been severely disrupted since the fire, and it expects larger trading losses for some time to come. Adjusting or not adjusting?
Non-adjusting.
Non-adjusting.
The damage was caused. The damage was caused. Hello?
Yeah.
The damage was caused by fire, which didn't have a pre-existing conditions before the reporting date.
Okay.
So this is non-adjusting and ends with disclosures, and if any provisions may be made.
If you are saying there's a no adjusting, you can't make the provision for this year. Provisions will be made from next year.
Yes, that's what I mean.
Okay. But the issue is the question added a clause there. There was a clause there. There was a clause there that the trading operations have been severely disrupted. Yeah, HP. I wanted to say something.
adjust them, but at the end of the current year, you strike the difference between the cost of the goods that has been burnt by fire and the recovery, the claim they are getting from insurance, which is 9 million. And that will be the loss in value in your P&L. And that is at the current year.
No. If you are saying no, we don't adjust, no adjusting event.
Yes, you don't adjust.
So there is no, the loss that you are taking will be the disclosure of the amount.
Yes.
Okay.
So, Brain, the last part of the question you were referring to.
Yeah, I will talk about that one.
Oh, okay.
So you see the last part, they are saying that the company is expecting future trading losses, isn't it?
Yes.
So if this is going to affect the going concern of the company, and the company want to cease because of the future losses, they want to cease operation after this year, then the event should be treated as what? Adjusting event. Because the financial statement will be prepared based on what? Break up what? Values. But if after this particular revelation, the company also decides to operate again, then this should be a non-adjusting event. But the event itself is a non-adjusting event. But if it is going to affect the going concern, that the company, because of the future losses, they want to stop operation now, then the event will be treated as what? As an adjusting event. But if that's not the case, then the event itself is a non-adjusting event. So you say the first thing as a non-adjusting event and you give explanation. But if there is some other things over there that you can comment on, like the future losses and those things, they are just telling you that they are material to what? To the operation. This particular event is a material or it's material to the operations of the company. If it is material to the operations of the company, is it going to affect the going concern of the company? If no, then the event is a non-adjusting event. But all those issues over there are just telling you that this particular event is material. Therefore, you should give a disclosure about what? The event. So it's a non-adjusting event and disclosure should be given. Don't look at what the thing is causing. What is actually the cause of what is happening? What is actually the cause? Is a fire outbreak. There's no evidence of fire outbreak. But if at the beginning of the year, the directors estimated that there will be a fire outbreak at the end of the reporting period, it means that we have all the evidence to say that, okay, we estimated that. Are you okay? So that will be an adjusting event. But there's nothing. We are just there, the thing happened.
So then it means that anything about fire, it will be a non-adjusting because
Exactly.
nobody.
Exactly. All the natural disasters, they are all.
Nobody can determine it.
Okay. All the natural disasters are not adjusting events.
Brian, if you have a consultant telling you that this can happen because maybe your business, say, for example, maybe those producing mattresses and all those things, normally they are susceptible to fires and all of that, and so these might be preconditions which could, or the likelihood could be high. Okay, depending on the business that you are doing, what do you do? Then you can actually say that these are preconditions, isn't it?
Yeah, if that is the case, you make references to past experiences, because that's not the first time that you are starting or you are producing or the business is going to be in existence. So if the consultant is telling you that there is a likelihood that fire outbreak will happen at the end of the year, then you make reference to past experiences that, okay, were there any fire outbreak for the past years? If yes, then you can confidently make provision for the fire outbreak. And if it happened at the end of the year, because we foresee it, we have already made the provision for it. Then if we pay any amount higher, then we just revise our provision. That's all. So you cannot just rely on what the consultant is telling you. There should be an evidence based on your operations. Were there any fire outbreak during your operations before? If yes, then it is likely that it will happen. And with the fact that the consultant is giving to us, it is likely that it will happen. Then you can make provisions. You make the provisions from the beginning. By the end of the year, you just revise it. Nice one. All right, Senior, I hope you are clear with that particular side. Senior, are we clear
Yes.
with that side? All right. Let's look at the C.
Yes.
Let's look at the C. The C, a single class of inventory held at another warehouse was valued at a cost of what, 460,000. At the year end, just after the year end, 70% of this inventory was sold for what, 280,000, on which the company sales staff earned a commission of 15% of the selling price. Adjusting or not adjusting? Adjusting or not adjusting?
Adjusting.
No, adjust.
Hey, someone is saying adjusting, someone is saying no adjusting. Which one are we picking?
Adjusting.
Adjusting.
Okay,
It's adjusting.
okay. So if it is
Justify it.
This
If-
inventory was sold for.
if it's an adjusting, what is the justification and what amount are we going to use for the adjustments? Okay, let's, all right, yeah, adjust.
You could see that the initial carrying amount of the asset is 30 million. The initial amount of the asset was
Madam, speak up a bit for us.
okay. The initial amount of the inventory is 160,000, but at the end of the financial year, the company sold it at 180,000, which shows that there is an impairment
Of the inventory.
180,000. So the impairment here shows an evidence.
The inventory, isn't it?
Madam, can you speak up?
We can't hear.
He's
So what
sleeping.
she's saying, what she's saying is that the cost at the end was 460, between just after 70% of the inventory, which is 460, was sold for 280. So what she's saying is that there is an impairment in the cost of the inventory after the year end, plus the sales staff also earn the commission.
All right.
Of the
So
selling price.
that is it. You see, if there is an issue relating to an inventory, the inventory was there throughout the year. The inventory was there throughout the year. So what will happen is that at the reporting date and after the reporting date, what is the net realizable value of the inventory? What is the net realizable value of the inventory? Okay. So if the net realizable value or the inventory, the cost of the inventory was 20,000. At the end of the year, the inventory was sold for 18,000. Can we argue that the actual value of the inventory at the reporting date should have been 18,000?
Correct.
Can we
Yes.
argue like that?
Yes.
Yes. So the argument is the inventory should have been 18,000 at the reporting date. So let's just go and adjust for let's now bring the inventory to 18,000 at the reporting date. So the amount that you sold the inventory, if there's a reduction, the reduction will be adjusted for. But if you sell it higher than the amount that you should sell it, then the sales will be accounted for the subsequent year. It will not be adjusted because inventory should be carried at lower of cost or its net realizable value.
Yeah.
And at the date of reporting, the carrying value is lower than the net realizable value. So we still take the cost or the carrying value. HP, your hand is up. Or it's the old one. HP, your hand, is it the old one?
Hello.
Yeah, HP.
So, Ben, the issue of recording the actual, 18,000 instead of 20,000, what is the window period? Because per your argument, the inventory was existing throughout the year. So if it is existing throughout the year, and then our reporting date is 31st December, and we sell this thing around March, because the question says just after.
If you are selling around March, but it was sold before the financial statements were authorized for issue. So if the 31st December, the adjusting events or the events after the reporting date are the event that happened between the reporting period and also the day that the financial statements were authorized for issue. So after the financial statements were authorized for issue or were published, there's no way you can adjust anything again. So if it was sold in 31st March and that time the financial statements were not published, we are still with the management has not officially signed it, we can still adjust it. We can still adjust it.
Okay.
So the date doesn't matter. If it falls between the date of authorization and the reporting date, you will still adjust it. So the question now is the value of the inventory at the reporting date was what? 460. And they are saying that 70% of this was sold for how much? So let's find the cost of the 70%. What would be the 70%? The cost should have been 0.7 times 460,000.
322.
320,000, isn't it?
322.
322,000.
322,000. Okay. But the question is, it was sold for how much?
280,000.
And on top, the sales staff has received a commission of what?
15%.
So the net realizable value of the inventory, will be 85%. Am I correct?
Yes.
Okay. So that will be 85 times 200,000. Or if you like, you can treat the commission as a separate item. But the only thing is we have to net the commission against the sales. We have to net the commission against the sales. So you have to net the commission against the sales. Okay. So let's now come here. What will be the net realizable value?
$138.
138.
238.
Okay.
200.
Okay. 238. So what is the difference now? The net realizable value is lower than the cost. So what will be the difference?
84,000.
So the 84,000 will be debit profit or loss. 84,000. Then what will happen? You will now go and reduce the inventory. So credit inventory, because the inventory will be carried at 322,000. Now it is 238,000. So you reduce the inventory to 238. And before the year starts, then you now sell it for the 238. That's all.
Yeah.
So,
hello, sir.
yes, senior.
Hello, sir.
Yeah, I can hear you, senior.
Yes. My problem is how. Okay, my problem is how you the commission. He said the question says it was sold for. So is the 15% not to be calculated on the 280,000 instead of adding the?
I've calculated that. That's why if you calculate 15% on 280,000, what are you getting?
42,000.
42,000. You subtract it from the 280. What will be the remaining figures here?
238.
Okay. Okay. I get it.
Yeah.
Thank
so
you.
what I did was a percentage decrease.
Yes.
Okay.
Sorry. Thank you.
All right. Let's count to D. Let's count to D. Then we move on to accounting policies and estimates. The notification of the bankruptcy of a customer, the balance of the trade receivable, due from the customer at the year end was 238,000. And at the date of the notification, it was 25,000. No payment is expected from the bankruptcy what? Proceedings.
Justin.
This is an adjustment, isn't it?
Yeah.
Okay, the bankruptcy just states that we should make a provision for the receivables, the provision for doubtful debt at the year end, but we failed to do that. So let's just make the provision, that's all. So what will be the provision? What will be the bad debt? What will be the bad debt amount? Before the notification, what was the amount that we are saying that the customer will be owing us?
23,000.
Look at it again. At the date of the notification, it was 25,000.
25,000. Yeah.
But the new amount that we are saying that we are going to collect is what?
23,000.
So that's what they are saying. So the bad debt will be what? 2,000. And you also reduce the customer's figure in the balance sheet by 2,000. So the balance of the trade receivable due from the customer at the year end was 23,000. At the date of the notification, it was 25,000. So the new balance that we are estimating now is 23. But the balance that we have before they notified us is 25,000. So the difference is the 2,000. So this will be adjusting events. This will be adjusting events. I said
Come again. Please come again, Ali.
I said this will be an adjusting event. That was the last thing that I said.
Yes, but it says the balance of trade receivable due from the customer at the year end
was
23,000.
Yes.
And at the date of notification, it was 25,000.
Yeah.
So it's an increase here.
It's not an increase.
It's a decrease.
The notification that they are giving to us. The notification that they are giving to us. So at the date of the notification, at the date of the notification, it was 25,000. At the date of the notification, it was what? 25,000. But the new balance that we are expecting from the customer is now 23,000.
But the 23,000 is at the year end, and the 25,000 came after the year end.
The balance of the trade receivable due from the customer at the year end, the balance of the receivable due from the customer at the year end was 23,000, and at the date of the notification, it was 25,000. Okay, so if you are looking at it like that, then that will be an increase. But the way I'm looking at it is that the notification was given before we determine the balance. The notification was given before we determine the balance. Okay, but in actual sense, the balance should be determined before we receive the notification, because the notification will be received after the year end. After the year end. So the balance should have been 25,000. The notification should have been 23,000. All right. So maybe I have to go adjust before these are all happening after the year end. So the balance, the notification should be received after the year end. So if this figure is correct, then there's nothing that we can do, because there is no bad debt there. There's no bad debt there. But the question is talking about adjusting events. So the balance should be 25,000 and the notification amount should be 23,000. But I was saying that the balance was 23,000 and before we received the notification. So my interpretation is the notification was received before the year end, or the notification was received before we revised the trade receivables. That is why we are having a bad debt of that. Okay.
But if we are speaking to this question, like on the face of the paper, what the question is stating, what would the solution be?
It should be after the balance will be at the end of the reporting date. That will be 23,000. So the notification will be received after the reporting period, because the question says that all these things are happening after the year end. So in this case, no bad debts, no adjustment. Because you can see the debtors figure is what? Increasing. So there will not be any bankruptcy, because if the balance that we have to receive from the person is still increasing, there is no bad debt. But that is not the focus of the question. So the focus should have been the year-end balance should have been 25,000. Maybe I was the one who made a mistake. And the notification figure should have been 23,000, so that we see that there's a bad debt of 2,000.
Linus,
Yeah.
The question, the way I'm reading this as well is, this is bankruptcy. What it means that the customer is not able to, pay off his debt to us, isn't it? So why aren't we adjusting the whole receivable from this customer as, why aren't we writing it off, the full amount of?
The notification of the bankruptcy of a customer, the balance of the trade receivable due from the customer at the year end was 23,000, and the date of notification it was what, 25,000. So this one is not something that is relating to the entire receivables. It is relating to only that particular customer.
Yes. What I'm saying is that particular customer is in bankruptcy. There's no way we are going to get, even whether it's 23 or 25. There's no way we are going to get any money from that customer.
Okay.
That's when we receive the notification.
Okay.
So we must write it off completely. That's the adjustment that has to happen.
You have a point. Yeah. You have a point. Whether the notification is there or not, still, since the person is into bankruptcy, the person cannot pay us.
Yes.
Okay. You have a point. Yeah, Samuel.
Yeah, so according to the explanation you gave to us and according to IAS 10, you made us understand that adjusting events, they are those events that provide evidence of condition that existed. That word is existed at the end of the reporting period. So the notification of the bankruptcy of a customer, it is an evidence that, if you read it, it said the balance of the trade receivable, there's a colon there. Let's take a look. A balance of the trade receivable due from the customer at the year end was 23,000. So that's why I also think that this question is the right question, is the correct question, because the notification is like an evidence of condition given to us that this thing is going on within. And the question there is talking about is giving us an amount at the end, at the year end, which is the 23,000. So for me, I think the question is correct. To me, I think it's correct. So for me, I think the correction is correct. There's no thing about it that the question is not correct. So to me, I think the question is correct.
No, we are not saying that the question is not correct.
Okay.
The side that we are analyzing it. If you are saying that someone is doing bankruptcy and the person is owing us 3,000, and after we receive this thing, the person is the amount that we are going to receive from the person is 25,000. So I'll go by what this Philip said, that this is a bankruptcy. This is a bankruptcy. Whether you receive all the amount or not, the person will not pay you. The person is out of business. So the person will not pay you. So you just have to make provision for the entire amount.
I think I was talking towards when you were saying that you are going to go and look at the question again. That was what I was talking about.
No, the side that we are picking it from. You are saying that you are owing me 23,000. And at the time that I've realized that you are now owing me 25,000.
Okay.
It means that I should not make any provision for you, because the amount that you are owing me is not reducing, it's increasing.
It's not reducing, yeah.
I should not make any provision. But Philip is saying that this is a bankruptcy. Bankruptcy, you don't have any issue. The person, whether the amount is increasing or not, the person will not pay you because the person is out of business. So you just have to make provision for the entire amount. So the question now is, I'll go by what Philip said. So this is a bankruptcy, whether you like it or not, the person will not pay. So what amount are we now making provision for? What amount are we now making the provision for?
25.
Is it going to be 23,000 or 25,000? Is it going to be 25 or 23?
It has to be 23, because at the time that by the year end, that's how much you have. That's how much you've recognized in the name of the customer. But the notification came at 25, and so perhaps there might be something that there might be a reconciliation that must
It could
happen.
even be interest.
It could, of course, that's true, Nick. It could even be interest on it, but what is actually recognized in the books is 23,000 worth of sales to the customer. And so I believe that we need to make provision to write off 23,000.
Okay. So you only remove what you have in the books. But the
Yes.
25,000, it can be like an error happens during the year, which there was an additional sales to the customer, but it was not recognized. So what you do is that if it's an error, then you have to correct the error by you now crediting sales and debiting the customer and now remove 25,000. But all things being equal, if there is no errors and the 2,000 was not recognized. So if you want to recognize all the 25,000, it means that you have to go and adjust for the 2,000 before you come and subtract all the 25,000. So the figure that you are going to subtract will be the one that you have in the books, and that is 23,000. That is 23,000. All right. So you can try some of the questions on your own. The remaining ones you can try them. They are not demanding calculations. They are straightforward, using the idea of okay.
Please, your response on the...
Hello, Senior.
Yeah.
Yes, I wanted to be clear on the what is it, whether stuff that qualify as what's it? So are we saying that things like, because the company a company that is already in operation will always have inventory, will always have account receivable. So are we saying that because those accounts existed before the end of the year, everything concerning them would be what is it? What's it? I'm sorry. Please let me get back to you. Yes. Is that what you are saying? So in that case, it will only be things like lawsuit, and other natural disasters that would be non-adjusted.
No, lawsuits. If it is during the year and you settle the amounts at the end or after the reporting period, it is an adjusting event. But if that is happening after the reporting period, then that will be the non-adjusting event. So if you have a court case that is during the year and you settle the amount at the end of the year, that will be an adjusting event because the court case was there before the financial year ends.
Okay, so but in cases like inventory and account receivables, if the company is in operation, it means that almost every year we'll have these two items. So that's what I'm saying. It means that questions regarding items that are normally on our books will be adjusted, right?
No, please. No, please.
Please, can you make it the rule clear to me, because I'm a bit confused here.
Okay, I've said that. I've said that first. I'll say it again. I'm saying that if at the end of the year your inventory that you are reporting was 20,000, isn't it? That is the example. The inventory was 20,000, but
okay,
after the reporting period, you have sold this inventory for 18,000. Maybe after 10 days. After 10 days, you have sold the inventory for what? 18,000. If nothing is said about the damages or something happened that is causing the inventory to be sold at 18,000, we can confidently say that at the end of the year, the inventory value was what? 18,000.
Okay.
Can we say that? If nothing was said about there was a damage, there was an outbreak that causes that. If nothing was said like that, we can say that the actual value of the inventory at the reporting day should have been 18,000. That was how come you sold it 18,000 after 10 days of the reporting period. Can we say that?
Yes, I think so.
Okay. No, you don't say you think so. Can we say that?
Yeah, we can say that.
So what we are coming to do is that, okay, the inventory should not have been 20,000 at the reporting date. It should have been 18,000. So let's now make it 18,000 at the reporting date. Or the IS2 inventory says that inventory should be carried at lower of cost or its next realizable value. So we can say that at the reporting date, the cost was 200,000, but the net realizable value, the amount that you actually sold it was 18,000. This is the figure at the reporting date. So we should have picked 18,000 instead of 20,000. Okay.
So in this case, it will be adjusting, right? It will be an
it will be
adjusting.
adjusting. Yeah. If the item is going to cause a reduction in the receivables or in the inventory, then that should be adjusted. So the amount that you sold the inventory after the reporting period, that is the net realizable value. So if the inventory was sold at 25,000 after the reporting period, we can also say that at the reporting date, the net realizable value was 25,000 when the cost was 20,000. So at the reporting date, we pick the lower, we pick the lower of any of the two. That will be the cost. So we are not going to adjust it because at the reporting date, the net realizable value is higher than the cost. So we pick the cost.
Okay, thank you.
Are you okay? The same thing applies to what? To receivables. Receivables should also be shown as what? Their net realizable value, their net market value. So if you are having 25,000 and they are now telling you that customers owing you 2,000 cannot pay, it means that this should be shown as what? Their present market value or their current year market value. It means that at the reporting end, this is the what? The value that we should be reporting for receivables. So we pick the 23,000. But if the receivables is increasing, the increment is for the what? The subsequent year, so we don't adjust it. So for the receivables and payables, if there's a reduction, we only adjust for any loss or bad debt. Any loss or bad debt. But if it is increasing, we don't do any adjustment for it. All right.
Okay, thank you.
Okay. Let's look at what we call the changes in accounting policy, estimate, and errors. Okay. What are accounting policies? Accounting policies. What are accounting policies? Accounting policies.
Okay, so can we say that the accounting policies, they are like like principles and maybe rules and practices of an organization, which they use to prepare and present their financial statements?
Yes, please, we can say that.
Okay.
Okay. So the accounting policies are the assumptions, the principles that the preparation and the presentation of the financial statements are being based on. So if we pick property, plant, and equipment, how are we accounting for that? We are using revaluation model or cost model. So the revaluation model or the cost model is now the accounting policy. Is now the accounting policy. So how do we measure our inventory? Do we use FIFO or we use weighted average? That is also the accounting policy. So how financial statements or how items, events in the financial statement should be accounted for or should be presented. The assumption that we use to do that is what we call the accounting policies. So the question is, if the entity acquires an item or there was an event, the entity now has an event that is happening for the first time. That is happening for the first time. What would the entity do? What would the entity do? The event that is happening now is different from those events that the entity is similar with. Okay, the entity is into, okay, the entity has cash, they have everything, and now the entity purchase disposable caps or they purchase expensive glasses. Okay, you can see that specifically, you can't see disposable caps being covered by a particular standard. You can't see how we should account for what the expensive glasses that the company has purchased. There is no standard that is specifically stating how this thing should be accounted for. So the entity will think is there any already standard that is regulating this particular item, this particular event? Is there any standard that is regulating it? If yes, then that particular transaction or event that is happening for the first time should be accounted for in reference to what? That particular standard. So the company now, they have cars, they have computers and those things, and the company now decided to go into plantation or mango plantation or something, and now they have planted, or they have now planted a mango tree, and they don't know how they are going to account for the mango tree because this is the first time that they are going to this one. So they have to ask themselves, is there any specific standard relating to how we should account for mango tree? Yes, there is a standard. That is IS 16, property, plant, and equipment. It tells us how we should account for burial plants. So in that case, you are going to use IS 16 to account for that because there is a standard for that. But if there is no standard specifically relating to that particular transaction or item that the company is incurring for the first time, what would the company do? There's no specific standard, but we have to account for this. We have to present this in a way that will be relevant to what? To the users of the financial information. We have to present this in a way that will be reliable. It will be faithfully represented. It will present economic what? Substance. So how do we go about this? Management now has to use their judgment. Management has to use their judgment because there's no specific standards relating to that. So management must now use their judgment. Using your judgment, you first have to ask yourself, this particular item, the disposable cup, the expensive glasses, how would they be classified in the financial statement? Are they going to be classified as an asset? Are they going to be classified as a liability? Or they are going to be classified as an expenses or income or equity? How would they be classified? So the management must make reference to what? To the definitions given by what? Definition, recognition, measurement given by the conceptual framework. Because the conceptual framework is there to guide us on issues that are not regulated by a specific standard, how we should go about them. So in your attempt to select the accounting policy to account for this particular new item, which is the disposable cups and the expensive glasses that the entity has purchased, which is for the first time, you have to make reference to what? To the conceptual framework. These items, are they going to be reported as an asset or liability or equity? If you're able to establish the element that they will fall under in the financial statement, then you cannot decide whether it will be a current asset or it will be a non-current asset. It will be a current liability or it will be a non-current what? Liability. Having made reference to the recognition criteria, measurement, and those ones, the management can also make provision to recent pronouncements made by what? Relevant what? Industries or relevant professional bodies. So is there any recent pronouncement made in respect of these particular items by any professional body or any standard making body? Is there any pronouncement made as to how we should account for this? If yes, then let's go by what they say. If no, then let's make reference to what the conceptual framework is saying. So if there's no specific standard, because we don't have disposal, if you pick all the standards, we don't have any of them stating specifically that this is how disposable cups should be accounted for. But disposable cups, what is the nature of the company? The company is into food industry. They are restaurants. So the disposable cup or disposable plate will be seen to be sold together with what? The food. In that case, that particular disposable cups can be treated as what? As an asset. Which type of asset? Current asset. Which part of the current asset? Inventory. Because we are selling it together with the food. And disposable cups might not be there for 1 year, or they might be used during the, so it will be treated as part of the inventory, the food itself. But if you come to expensive glasses, we are going to use it to what? To generate revenue. These are the things that we are going to put water into for the customers. They will be there for long. So that can be classified as what? A non-current what? Asset, as part of PP. So in selection and applying accounting policy, first of all, management or the accountant must ask himself or herself that the event that is happening now, the new event, Is there any specific standard regulating that? If yes, then you have to account for that particular event using the what? The stated standard or the specified standard. But if there's no standard, management must now make or use their judgment to present this particular information in a way that will be relevant to the users of financial statements. It should also be reliable, that people can make economic decisions based on that. It should be faithfully presented. It should also have what we call sometimes overform. So management must now use their judgment, making reference to what? To the conceptual framework, the definitions, the measurements, and the recognition criteria. They should also make references to what? Recent pronouncement made by other professional bodies so that they can be able to present this particular event in a manner that will be relevant and reliable to what? To the users of what? The accounting information or the financial statement. So that is the selection and application of accounting policy. For the first time, if the event happens for the first time, ask yourself, is there any standard regulating this? If no, then what do? We need to account for this. Management must use their judgment or their professional judgment to account for this. Using your professional judgment, you have to make reference to what? The conceptual framework. What does the conceptual framework says about this? Or which parts of the element will this particular item fall? And what is the recent pronouncement made by other professional bodies about this particular item? So use this to make sure that the presentation will be relevant, or the way you are going to account for that particular transaction or item will be relevant to the users of the financial information and also be reliable. People can see that it is faithfully presented. There is no issue with bias. There is no issue with errors. It is representing economic substance, which is a substance of a form, and other issues. That is the selection and application of the standard. They can ask you, how should a standard be selected and be applied? Okay, these are the things that you are going to see. Okay, let's come to what accounting policy is, or what a change in accounting policy is. Okay, a change in accounting policy arises when there is a what? A change in the what? Representation of a particular item. Example is, first, you are expensing borrowing costs. First, the company was expensing borrowing costs. Now, the company has now decided to capitalize the borrowing cost. You can see that there is a difference, or there is a change in how this particular borrowing cost has been presented. First, there's a change in the presentation. So first, our policy is that we are going to expense it. Now we want to what? Capitalize it. This is a change in accounting policy. This is a change in accounting policy. If the entity decides to now change from revaluation model to cost model, this is a change in accounting policy, because the revaluation model and the cost model are policies. Both are policies. So this is a change in accounting policy. If the entity decides to use FIFO method for their inventory valuation, that is an accounting policy for them. But if they're now changing to weighted average valuation, that is a change in accounting policy. That's a change in accounting policy. So if you are classifying expense first as cost of sales, now you want to classify it as an administrative expense, that is a change in accounting policy. So you have to pay attention to what a change in accounting policy is and what a change in accounting policy is not. If we talk about change in accounting policy, we are talking about management moving from one policy to another with the same item. The inventory we are valuing using FIFO first. Now we are using weighted average. That's a change in what? In the valuation model. That's a change in accounting policy. PP, we are using cost model. Now we want to use revaluation model. That is a change in accounting policy. But if you are coming to apply, okay, change from expensing rent to right of use asset, and okay, that is also accounting policy. So a change in the recognition of an item, presentation, classification are all a change in accounting policy. But if the entity purchased the item for the first time, you just purchased the item for the first time and you apply accounting policy to it, that is not a change in accounting policy because you are not applying any policy to that particular item before applying the new one now. So if you are applying accounting policy to a new item that is different from what has been happening, that is not a change in accounting policy because you are not using any different one that you are coming to use this one. This is the first policy that you are using. That is not a change in accounting policy. And if you're also applying a new policy to those items that were not happening first, you are applying a new policy to those items, or you are applying new policies to new items. That is not a change in accounting policy because there was no previous accounting policy. So if you talk about change in accounting policy, there should be a movement from one policy to the other for the same item or for a particular item. But if you are applying accounting policy to a new item for the first time, that is not a change. If you are applying a new accounting policy to a new items, that is not a change. So you should pay attention to that. If there is a change in accounting policy, what will happen? If there's a change in accounting policy, what will happen? If there's a change in accounting policy, the change is being applied in a way that we call it should have a retrospective effect. The change will be having or will be applied retrospectively. Retrospective application means that we are applying the principle or the policy as if it was there from the start. So if you are changing from cost model to revaluation model, you will now apply the revaluation model from the date that the asset was purchased. You apply as if the revaluation model was applied to the asset from the date of acquisition. That's how we apply for change in accounting policy. The change will be applied retrospectively, as if the application was there or the policy was there as at the date of what acquisition of the asset or as at the first start of the transaction of the item. But what if there is no previous items that you have to adjust? If the change cannot be applied retrospectively, it is impracticable. You cannot get the items to now adjust it. Then the change will be having prospective effect. If the retrospective application is impossible, it's impracticable, cannot be applied, then we accumulate all of them and take it from the day that the policy was changed. But if there is no indication of it being impracticable, then the change will be applied retrospectively. The application is done as if the change has been there since. That is a retrospective application. That is all about a change in accounting policy. So you take the question, look at it well and know whether it's a change in accounting policy or it's a change in an estimate. Okay. The question, the standard says that when should a company change an accounting policy? When should a company change an accounting policy? When should you change an accounting policy? You cannot just stand up and change an accounting policy. When should companies change from IAS 17 to IFRS 16 leases? When should they do that? Because this particular change is required by the what? By the standard board. So a company can change an accounting policy if the change is being required by the standard board. The change is being required by the standard board. So that is a condition that a company can. We are looking at conditions that an entity can change an accounting policy. The entity can change an accounting policy if and only if these two tools are there. The change is required by what? By the standard board. Like changing from leases, the old leases to the new leases now. Or changing from the first revenue from contract to the new one now. Changing from financial instrument to the new one now. These changes are required by what? The Financial Accounting Standard Board. Another way, if the change is not required by Financial Accounting Standard Board, the entity has now seen that this particular change will provide a reliable and relevant information to the users of the accounting. The entity can go ahead and what? Change the accounting policy. So the entity is of a view that management is of a view that the change in accounting policy will give relevant and reliable information to the users of the accounting information or the financial statement, the entity can go ahead and also change the accounting policy. Can also go ahead and change the accounting policy. Let's come to estimate and what we call change in an estimate. Okay, before I want to talk about consistency of accounting policies. Okay, consistency of accounting policy is basically about if there is a change, the entity should be committed to what? To the application of the change. So if you are changing from revaluation model, so the revaluation model should be applied consistently, should be applied every year. Don't go back to the cost model. That is the consistency of the accounting policy, consistency of the application of the accounting policy. The new change should be applied consistently. There should not be any way of going back to the old one. And this will also ensure comparability. This will also ensure comparability. Let's come to accounting estimates. Let's come to accounting estimates. Estimates are always like something like judgments. Estimates are always something like provisions. Okay, so you are not sure and you are just making a reliable estimate with some facts. You are just making some reliable estimate that, okay, this might, at the end of the year, this might be the figure. But in actual sense, that is not the figure. So it doesn't mean that this figure was there at the, no. What will happen is that, okay, you are estimating that this is the amount. You don't know. So at the end of the day, this is the amount. That is an estimate. That is an estimate. So the estimate is not going to change the classification, representation, and recognition of the item. It's not going to change anything. Anything that is going to change the recognition, the classification and representation of the item is what we call a change in accounting policy. The estimate, the item will still be like that, but just that the figure that we are going to recognize is the one that will be different. The presentation will be everything. The figure is the only thing that will change. So if you talk about changing an estimate, we are talking about an adjustment in the liabilities or in the carrying value of a liability, asset, equity, or any other income or expenses. We are just doing an adjustment to the what? To the item. It will not change the recognition of the item. It will not change the classification. It will not change the representation of the item. So examples of estimate can be how revenue will be recognized. We are saying that whenever we sell, we should recognize 50% of the revenue. Now we are saying that we are going to change it to 60%. It doesn't change that revenue will not be classified as an expense, no. Or revenue will not be classified as a liability, no. But just that we are reviewing our estimates. So if the thing is about something that you are going to receive, you are making provision for something that you are going to receive, and the thing has changed, that is what we call a change in estimate. So how revenue should be recognized is a change in an estimate. A change in the useful life of an asset is a change in an estimate. A change in an useful life of an asset is a change in an estimate. Provision for doubtful debts, a change in a rate should be a change in an estimate because you are just estimating the amount of the debtors that will not pay. If you're also reviewing your warranty obligations, warranty is like a provision. So you are saying that this is the amount that you are going to give to the people. At the end of the day, this is the amount that you have given. There's a change in a percentage. That is a change in an estimate. That is a change in an estimate. There's a change in the residual value of an asset. That is a change in an estimate. You are just estimating a value. So if the value has been revised, that is a change in an estimate. But anything that is going to change the classification, representation, and recognition of the item, that is what we call a change in accounting policy. You have to take note of that. Okay. What will be the application of a change in accounting estimates? What will be application of the change in accounting estimates? Okay. If there's a change in an estimate, the change should be applied prospectively. It should take effect from the date of what? The change. It should take effect from the date of the change. So prospective application means that the change should take effect from the date of what? The change. That is a retrospective. That is the prospective what?
Prospective.
Application. That is a prospective application. So a change in an estimate should be applied what? Prospectively. So if depreciation method changes, if you are changing depreciation method, would that be a change in accounting policy or change in an estimate? If you
Change
in estimate.
yes, because the depreciation is giving you, the method is giving you the value that you'll be taking to profit or loss every year. The change in the depreciation method is not going to change how the depreciation will be recognized. It is not going to change how depreciation will be classified. Depreciation will still be classified as depreciation, but just that the amount that you are estimating to be carried to profit or loss at the end of every year will change. It's only the figure that is going to change. So anything that is going to change the figure, only the figure, will not be a change in accounting policy. But if the thing is going to change how the thing should be recognized, how the thing should be presented, how the thing should be classified, that will be a change in accounting policy. Borrowing cost is now capitalized. It means that we are moving from expense to what? This one. The recognition is now different. The classification is now different. All right. So don't see a change in the depreciation method and as a change in accounting policy. Let's come to correction of errors, and we move on to some questions. Then we are done for today. Okay. Errors. What is the difference between mistake and not mistake and error? What is the difference between fraud and error?
Intentionality.
Okay. The difference lies with the what? The intention for the intention. Okay, the difference lies with the intention. Okay. Okay. So if the error, you are doing it without knowing that you are doing the wrong thing, that will be classified as an error. If you are doing a mistake and you don't know that this thing you are doing it, or you are not doing it for your own personal benefit, that will be seen as what? As an error. But if you are committing it for your own benefit, it means that you are aware of what you are doing. And that will be seen as what? As fraud. But in the IS8 accounting policies, change in accounting estimates and those ones, the application of the error and fraud, they all have the same application. The treatment is always the same for all of them. So if you talk about error, we are talking about prior period what? Errors. Prior period what? Errors, not errors that are happening in this particular year. No, this one, if it is happening in this year, it will be recognized for this year. But what if we have now discovered what? Errors or something that happened 2 years ago? How do we account for that? That's what that is our main concern over here. We have discovered something that happened 5 years ago. How do we account for it? How do we account for it? So prior period errors are omissions from the statements, are omissions from all, and misstatements in an entity financial statement for one or more prior periods arising from failure to use or misuse of reliable information that was available when the financial statements for that period were issued could have been reasonably expected to take in place or to take into account in those financial statements. So what we are saying is that it can be omissions. It can be omissions or misstatements that were recognized or that were made in the financial statement of the company in the prior period. These are happening because the entity or the accountant fails to take into consideration some information that are available, some information that are available during the year, but they fail to do that, or they also fail to take into consideration some facts. Okay. Errors include mathematical mistakes, mistakes in applying accounting policies, oversight and misinterpretation of facts, and also what? Fraud. And also fraud. So when there is an omission or there is a mistake in applying the accounting policy, that will not be seen as a change in accounting policy. Although you have applied the accounting policy, but you have applied it wrongly. So that will be seen as what? As an error. An error and a change in accounting policy have the same what? Application. Error should also be adjusted what? Retrospectively. errors also have what? Retrospective what? Application. The errors also have retrospective what? Application. Retrospective application. Okay? Without, that is all about. Yeah, Edwin. Edwin, your hand is up. Or it's a mistake.
Good afternoon.
Yes, yeah.
I have a practical situation. I need your advice.
Okay, since it's a practical situation, you have to pay me a consultancy fee.
I'll do that after the class.
And then let me also explain after the class.
Oh no. Maybe my colleagues will also benefit from it, but I'll bear the liability.
Then you both should share the liability and pay. Okay, let's move on. What is the issue?
Yeah, so a colleague works in a company where his director donated, well, he just offered his land, about a 5 plot of land for a warehouse to be constructed. And there wasn't any valuation on the land, so it wasn't incorporated in the books. But the value of the warehouse is on the books of the company. Then moving forward, years later, a governing board was constituted, and then the board advised that the evaluation should be put on the land, and then the director should be compensated. So they had two options: either to compensate him with shares or to recognize a director's loan as a long-term loan, which will be paid up in a number of years. So they went with the first option, recognizing it as an additional issue of shares to the director. But then they couldn't do the changes at Registrar General to effect the increase in the share capital. And into the second year, it was detected by their bankers, and it was causing issues because what they are showing at Registrar General is different from what the value the financials is showing. So they wanted to do the shift by picking it out of the equity, that means the share capital, and recognizing it as a director's loan. In so doing, it will be consistent with what is at the Registrar General in terms of the registered stated capital. So they approached their auditors to do the reverse, and it was a challenge. So we don't know in terms of the provisions of the standards, what is the way forward in what they want to do. Because the auditors had also already issued their report on the financials.
Okay. So
yes.
You see, what they have to do is this is not a change in our accounting policy, but okay. the one with the land. I want to talk about the land first. Is it that the company cannot determine value for the land, or they decide not to value the land? Is it that I want to know that part?
Yes, so in those, they decided not to value it.
They decide not to value the land, so they don't want to recognize the land in the first place.
Yes.
That is their policy. Okay. Now they are saying that they want to value it, so that will be seen as a change in accounting policy in the first place. But they are done with that issue. But the main issue over here is we now changing the equity to what? To loan.
Long-term loan.
Okay.
Yes.
The issue is they should not be having problem with the equity. If the company is a registered company, they should just recognize that as additional issue of what? Additional issue of shares. But I don't know whether they are listed company. Because they are listed, they will not have problem with that. But you changing the loan to, or the equity to loan now, okay, yes. You see, that thing that you are going to do will be something that the Registrar General is not part of, because the value that they have over there is not the value that you have. So that one, if you do it like that, we are in Africa and we are all human beings, so there's no problem with that one. Okay, what they have to do now is that they have to now see the equity now to this one as they have now spoken with the director or the shareholder. The shareholder has now decided to convert its equity shares to loan. That should just be done like conversion of equity to loan. So the transfer should be done from the statement of what? Financial position, where if you go to statement of changes in equity, you are going to change or you are going to say transfer of this one to liability. That should be done.
Okay.
That should be done. But if that should be done during the year, or this is after the financial statement has been authorized for issue, I don't know. But if they want to do it within the year, that would have been changing the equity to what? To liability. You have spoken with the people, they have decided to change the equity to liability.
Yeah, so that is what they decided to do. However, they wanted to do it retrospectively. So the 2022 financials, they wanted to reflect the new decision. But then the auditors are also not agreeing that they should go back and then rework on that.
No, that should have a retrospective effect, because you can see that you are changing the classification of what? The look,
Yes.
the land. The land was first should be recognized as an equity equivalent. Now we want to make it to be a liability. So if you want to apply it retrospectively, it means that all the things associated with the what? The dividend that you have paid to the person will now be converted to interest. So you calculate interest on the loan. You have to determine the what? The interest on the loan. Then what are the dividends that you have paid to the person? You take those dividends and now start calculating the interest on the loan as if the loan was there as at the time that we are classifying the what? The land equivalent as equity. So it will be retrospective, where you calculate the interest on it from that time and now subtract what? The dividend that you have paid as part of the interest to know the amount that you are owing the what? The director now, so that you report those ones as also maybe interest liability or something. But if you cannot be able to determine the interest amount from that time, then you can now do it from maybe the previous year. You can now adjust the previous year's financial statement. That's all. So it should be a retrospective effect. It should be a retrospective effect. It should be a change in accounting policy.
Okay.
All right. It should be a change in accounting policy. So you see, if this one, it is after the auditors have now audited the account and they have signed, there is nothing that you can do. You can only disclose it and do the written, do it next year, because everything has been done already. So you cannot go and now do some corrections in the financial statement, because are you going to prepare a new financial statement and sign it?
So for now, what you can do is a disclosure.
Yeah, a disclosure. But if the auditors are here to issue their report, then they can allow the entity to do the adjustment. Then they will now do the new audit. But the thing is, maybe the effect that will be having on their audit, maybe they will come and do a new audit again. That is why they are also not allowing the company to carry out that particular effect. But the auditors can also put that in their audit, in their audit findings, maybe other matters or something. Then they will put it there that there was this issue at this and this. The financial statements were not adjusted for that. That is all.
Okay.
All right.
All right. Thank you so much.
Okay.
Yeah, Lennox.
Yes, please.
Hello.
Yeah, I can hear you, Sina.
Yes, just to take you back slightly, just to take you back, the bit about the dividends and the interest. How are you treating that? You said that you need to convert all the dividends as interest. So what happens to what has been paid already?
No, you calculate the interest that you are going to pay on the loan if the loan was there since. So if the loan should have been there for 5 years now, and you know the interest rate, it means that you should start paying interest 5 years to now, isn't it? So you calculate it, the interest. Then what was the dividend that the person received? You total the dividend and now net it, because the interest will not be seen as part of the dividend will not be seen as part of the interest payment. So the interest that is supposed to pay the person is 5,000. If the interest that is supposed to pay the person is 5,000, And since the time that it was equity, you have paid dividend of 3,500. You have paid what? 1,005 out of what? The 5,000. So the remaining amount that you are going to pay the person now will be what? Will be 1,005. So you go and you see that the dividend will be taken from the profit, isn't it?
Yeah.
Dividend will be taken from profit. So the only thing is
Yeah.
that you go and adjust the profit by additional what? 1,005, because the dividend was already taken from the profit. So you come and adjust this one. So that's how you are going to do it. You calculate the interest and now determine the total dividend that you have paid. It means that the dividend that you have paid to the person was not a shareholder. So the dividend should have been interest. So you compare the actual interest that you should pay from that time to the dividend that you have paid. The difference will now be the additional interest that you have to pay in cash. So the additional interest should be adjusted against the profit as an expense, because the dividend was also taken from the profit. 5,000 should have been taken. We took only 3,500, so the remaining will be 1,005. That will be taken from the profit of the company, which might be in the retained earnings, because this is having a prospective effect. Are you okay with that side?
Yes. I'm okay. Thank you.
Okay, all right. So let's take, yeah.
Yeah, please. Now, what happens to the income tax?
The income tax, then you are going to adjust it. You are going to adjust the income tax on the what? On the interest payment. Sorry for that, because the interest is tax deductible.
But
so you calculate the interest, the portion of the tax that will be there, and you have to take approval from the tax authority before they can allow that as a tax credit.
exactly,
Because,
I was going to say,
yeah,
I mean, that has been paid already. So
so it's a whole issue on its own. You have to, before you can also enjoy the tax benefits, you have to take approval from the tax authority that you are now changing the loan from this. But the tax authority will not give you credit. They can allow you to subtract it from your current tax. That is the best that they can do for you. That is the best that they can do for you. All right, let's take some tutorial questions. Then we end it here.
okay.
Okay, let's take the last question, the last tutorial question there.
The question 11.
Yes, please.
Emerald has had a policy of writing off development expenditure of profit or loss assets it was incurred in preparing its financial statement for the year ended 30th September 2014. It has become aware that under IFRS rules, qualifying development expenditure should be treated as an intangible asset. Below is the qualifying development expenditure for Emerald. All capitalized development expenditure is deemed to have a 4-year life. Assume amortization commences at the beginning of the accounting period following capitalization. Emerald had no development expenditure before that for the year ended 30th September 2011. Treating the above as the correction of an error in applying an accounting policy, calculate the amount which should appear in the statement of profit or loss and statement of financial position, including 1 year's comparative figure and statement of changes in equity of Emerald in respect of the development expenditure for the year ended 30th September 2014. Note: you should ignore taxation.
Okay. So if you can say that they are saying that we should treat this as what? As a correction of error, isn't it? Okay. If this was not said to be a correction of error, it should have been a change in what?
A change in policy.
It should have been a change in what?
Accounting policy.
Accounting policy. You can see that they are now changing, writing off their development expenditure to profit or loss. They want to capitalize it now. So they want to change the classification and the recognition of the development expenditure. Okay. All capitalized development expenditure is deemed to have a 4-year life. Assume amortization commences at the beginning of the accounting period following what? Capitalization. Emerald had no development expenditure before that for the year ended 30th September 2011. So what is the total development expenditure for 2011?
300.
Capitalization was amortization will start in which year? Amortization will start in which year? All capitalized development expenditure is deemed to have a 4-year. Assume amortization commences at the beginning of the accounting period following capitalization. Emma had no development expenditure before that for the year ended 30th September 2011. So
oh, should I make it big?
I don't know.
right, don't make it big. All right. So the 2011 capitalization will start from which date? Hey, it's my Wi-Fi. Yeah, let's speed up. My laptop, the battery is going down. So let's speed up before. Let me solve this question before it went off. Let's change this one. All right. So 2011 capitalization, the amortization of it will start in which year?
2012.
That will start in 2012. Okay. So the 2011. So 2012. We count to 2012. Our amortization for 2012. Amortization for 2012 will be 300 divided by 4. Am I correct?
Yes.
Yes.
That'll give us how much?
That's 75.
75. Okay. So at the end of 2012, the carrying value of development expenditure, the carrying value of development expenditure will be 225 plus 240. Am I correct with that?
Yes.
Yes.
Okay.
Yes, please.
The carrying value will be 300. The carrying value for the 2011 one will be 300 minus the amortization. But in 2012, we will still capitalize additional 240. So the total carrying value will be 465. Are we correct with that?
Yes.
Okay. 2013, our amortization will now be in 2 folds, isn't it? We will still amortize the 2011 one, which will be 75. Then we amortize the new one, which is the 240. The 2012 one will be amortized in the 2013 because amortization starts 1 year following the what? The capitalization. So the amortization will be, the total amortization will be 75, which is this one will be 4 years, so it will still be 75 divided by plus rather 240 divided by 4. Am I correct with that? Yeah, HP.
The 225 for the 2013, won't we add that one to amortize it?
No, the amortization will still be on the 300. So it will be 300 over 4. So every year is 75. Every year is 75.
I know, okay, just because you wrote only 240, that's why I'm asking to be sure.
The 225, you cannot, you see the 240 will be depreciated over 4 years, but the 225
Definitely.
will be depreciated over 3 years. So you can't add
Yeah.
and depreciate all of them over 4. So you
I
can
get
do
it.
225 divided by 3 plus 240 divided by 4, because the
Okay.
first one, we are in the second year. So if you get amortization for all of them, it will be the same every year. So you can take the 75 and that is all. So the total amortization will be what?
135.
135. Okay. We are applying this retrospectively because it's an error. Even if the question didn't say that it's an error, it's a change in accounting policy which should have a retrospective what? Effect. So you should start the calculation for the time that everything started. Then you now use those figures to now do your adjustments. So your carrying value 2013, the carrying value for 2013 will be 150 plus what? 150. So 150 is the old one, which is okay. Let me make it like this. The carrying value for 2013 will be 225 plus 240, or let me just make it like this. It will be 465 minus 135. Would that be correct?
Yes.
Yes.
Okay.
Yes.
So that will give us how much?
330.
830. Okay. 330. Okay.
330.
330.
Okay. Let's count to 2014. 2014. Okay, this one plus there was additional what? Amortization for
800.
2013. So that would be plus 800. So we add the 800 to it. Okay. So that will give us 1130.
30.
Okay. 2014, the total amortization will now be the 75, which is the first one, plus 60. The 60 is the 240, plus the 800 divided by 4. The 2013 will be amortized in 2014. So we are going to have 135 plus 200. That will give us 335. Okay. So our carrying value for 2014 will be 1130 minus 335 plus the amortization for the 2014 year. That will be 400. So plus the 400 plus 400. What?
1195.
49.
1195.
1195. Okay. So let's now come to the question itself. treating the above as a correction of error in applying accounting policy, calculate the amount which should appear in the statement of profit or loss, statement of financial position, including 1 year's comparative figures, and statement of changes in equity of Emira in respect of the development expenditure for the year ended September 2014. So let's come to statement of profit or loss. Statement of profit or loss. So they say we should show 2013. 2014 is a requirement itself, but we should show 1 year what? Comparative. 1 year comparative. Okay. So we are going to have amortization. We are going to have amortization. Okay, 2013 is what? What is amortization for 2013? It was 335. So we are going to have 335. So we are going to have 335.
135.
So 135.
2014.
Yeah, 2014 is 335. You said 13.
2014 is 335.
Yes, please.
Okay.
And 2013 is 135.
Okay. 135. Okay. You see, they say you should show 1 year comparative. Okay. So 2009, if they say we should show 2 years, then 2012 will be 75. But since you are showing only 1 year comparative, this is how it will be. Let's come to statement of financial position. So we are going to have a development expenditure. Development expenditure. So this one we are going to show only the carrying value. So the carrying value was 1195 for 2014. 2013 was what? 1130. So 1130. Okay. Let's come to statement of changes in equity. Statement of changes in equity. Okay. Statement of changes in equity. What we are going to show is that we show profits and the rest. We show profit and the rest. So since we don't have profits, our amortization 2013, 2014, and 2013. Okay. So the 2014, the amount that we are going to subtract from the profit will be 335. It will still be the same as the 335. That will be the amount that we are going to subtract from the profit there, but we don't have the profit. So we just put a 335 there. If you count to 2013, 2013 would have been 135, but someone can decide to add 75. And I will explain why you are adding the 75. Okay. The 75 will be subtracted from 2012, and 2012 will become the opening balance for what? 2013. But since we don't have the 2012 figure, it means that we assume that the 75 will be taken away from the opening profit or loss of the 2013. So the profit over there, the profit that we are going to have as a profit or the balance brought down, the retained earnings balance brought down, the 75 for 2012 would have been taken from that figure. And to become the opening balance for 2013. But since we don't have it, we assume that the 75 will be taken away from the opening balance of the 2013. So someone can decide to add the 17. There is no problem with that. All right, let's take the last one. Question number Let's take question number 9. Question number 9. Auntie Eunice.
The Lakes Transport Company, DTC Limited, is preparing its financial statements for publications for the year ended December 31st, 2019. The draft statement of changes in equity is as follows. Additional information. DTC has now discovered an error in its inventory. Inventory was overstated by 70 million at 31st December 2019 and by $60 million as at 31st December 2018. The rate of tax on profit was 30% in both 2018 and 2019. You are required to prepare revised comparative income statements after necessary adjustments for the years ended 31st December 2018 and 2019. Adjusted statements of changes in equity as at 31st December 2019.
Okay. So you can see that we are giving what? The statement of changes in equity, which is a draft before the error. So you can see 2017 there. You can see DTC has now discovered an error in its inventory. Inventory was overstated by $70 million at 31 December 2019 and $60 million at 31 December 2018. The rate of tax on profit was 30% in both 2018 and 2019. Okay. So let's look at the revised profit or loss now. Let's look at the revised profit or loss now. So revised statement of profit or loss. Revised statement of profit or loss. We have 2019 and 2018. Okay. DTC has now discovered that inventory was overstated by what? 70 million at 31 December 2018 and by what? 60 million at 31 December 2018. Okay. The 2018 year, what was the profit for 2018?
$150.
The profit was what? 150. So let's take the
150.
profit. 150. And 2019 is what?
385.
385.
Okay. 385. Okay. Let's now come here. The first inventory, the 2018 inventory. The 2018 inventory there. That was what?
60 million.
Is it a closing balance or opening balance?
It's a closing balance.
Balance.
Okay. So if we are overstating our closing inventory, what will be the effect on profit?
It will increase profit.
Increase profit.
It will increase profit, isn't it?
Yes.
So if we want to adjust it now, what are we going to do?
We have to less it.
We have to subtract, isn't it?
That's from
Yeah.
the profit.
Okay. So this will be inventory will be subtracted from, that will be 60, isn't it?
Yes.
Okay. That will be 60 here. Okay. What will be the closing inventory for? What is the closing inventory for 2019, what was the overstatement?
70 million.
70 million. So this one we are dealing with the overstatement now, 70 million. So overstatement. Okay. If our profit is increasing, what is the effect on a tax? What will be the tax implication?
The tax will also increase.
The tax will also increase.
Increasing.
So since now we are reducing our profits now, it means that the tax element on the 60 million.
Mujahid.
Zabio. Ombe. Can't do
Madam.
So the meaning is that since we overstate our inventory, we paid a tax of what? We calculated a tax of what? The 60 million to as tax that we are going to pay. Because that portion of the profit tax was calculated on it. So the question now is, what was the tax figure that the overstatement brought to the company? The tax figure that the overstatement brought to the company. That tax figure will be adjusted. We have to adjust for the tax figure. But the question now is, what is happening? The 60 million, which is what? Opening balance for, the 60 million, which was opening balance for 2018 will be what? The 60 million, which was opening balance for 2018, which was closing balance for 2018, becomes what? Opening balance for 2019.
2019.
Okay. So it means that in 2019, our inventory was what? Our inventory was also overstated. Okay. Opening balance was overstated. HP, your hand is up.
When we finish this one, I have a question, please. Abeg, let's finish it first.
Okay. So if your opening balance is increasing, what is the effect on profits? If your opening balance is
increase.
If your opening inventory is overstated, what will be the effect on the profits?
Decreases.
Profit will decrease.
So what we do now is that we add the 60 back to the profits, because the 60 was treated as opening balance for this, which is an increment. Okay. Let's now go to the tax issue. Let's now go to the tax implication. Okay. So we are saying that our profit for the first year, our profit for 2018 should have been 110. But we made it what? 150 because we overstated our, okay, it should have been 90.
90.
150 because we have overstated what? Our profit by 60. In actual sense, we should have paid tax of what? We should have paid tax on only 90, but we have paid tax on the 150. It means that we have paid our tax in excess as a result of the what? The overestimation of the inventory. So the question now is, what is the tax element, or what was the tax that we paid on the 60? What was the tax that we paid on the 60? So
80 million.
The tax will be what?
18.
18 million.
18
million.
Okay. So that tax, what are we going to do? Are we going to add it back to profit, or we are going to subtract?
We'll add back.
We add it back. Okay. So the tax will be 15, isn't it?
Yes.
Okay. So that tax, we are getting a tax benefit on that. So that will be added. Let's count to the 72. What will be the tax on that?
18, no, not 15. It's 18 million.
Okay. Sorry. So let's count to the tax element on the what? The tax element on the 70.
That's 21.
Okay. That will also be what? Added. Because our profit is now reducing. So the tax that we paid on that particular amount should be refunded to us. But we're also going to have tax on the what? On the opening balance. On the opening balance. The tax on the opening balance. So that opening balance was actually what? Reducing our profits. So now we are increasing it. It means our tax will also what? Increase. Our tax will also increase. So in this case, we'll be having a tax of what? 18, which will be a reduction. All right. So let's add these figures now and get the final figure.
Lennox.
Yeah.
What figures are you calculating the tax on?
The opening and then the closing, the inventory figures.
Mm.
The profit was 150 for 2018. But we realized that no, we overestimated our closing inventory by 60. It means our profit should have been 90. But we paid a tax of what, 25% on 150. But the tax that we should have paid should have been on 90. So the question now is, we pay the tax, we pay excess tax on the 60, which is the overestimation. So since now we are now removing that particular 60, it means that the tax that we paid on it should also be removed. So 25%. So another way is that find the tax on the 150. Find the tax on the 150. Then you find the tax on the actual profit, which would have been 90. Then you find the difference. The difference will give you the tax paid on the what? The excess amount. That is the 60.
Okay.
So you are getting 18, isn't it?
Yes.
Okay. So we paid tax on 150, but we should have paid tax on 90. So what is the excess tax paid? It was on the 60. So let's find the tax on the 60 and add back. And add back. So 2019, what are we getting?
378.
378. Okay, 2018.
108.
108. Okay. Okay. Let's count to the B. The B, they say you should prepare adjusted what? Prepare adjusted. The adjusted statement of changes in equity.
Yes.
Okay. Okay. You see, I will show you how you can go about this one. You can do two or you can do only one. You can do it in two ways. Okay. So the first one is the figure that we have. Sometimes they can give you the closing, the inventory for 2 years, where they will give you one for 2017, which will be at the end of 2017. That will be opening balance for 2018. So you look at the effects, but this one they have given us for closing. Okay. So the actual profit that we should have added to the 90 should have been what? The actual profit for 2018, that should have been added to the opening balance, which is 90, should have been 108. Am I correct with that?
Yeah. Yeah.
Okay. So you can decide to bring that one as a balance brought down for this year, which will be 90 plus 108 will be 198. Okay. That will be 198. So you take the opening balance plus the actual profit. That will give you the opening balance for 2019. If you are looking from the statement of changes in equity. Okay. Should we present all the items one by one? I'm only interested in the retained earnings portion. So you can still have the revised statement of this one. You have your share capital, nothing is going to affect it. You have your share premium, nothing is going to affect it. But I'm only concerned about which one is the one that will be affected, which is the retained earnings. Okay. So let's come to 2019. What was the dividend paid?
100.
100.
Okay. What is the effect of dividend on profit? It will be subtracted.
Reducing the profit.
So 100. What is the actual profit for 2019?
378.
378.
Okay, 378. So this will now be your revised one. But you add your share capital portion and those ones, they will not be affected. That's why I didn't pay attention to that portion. So this is one way of going about it. So our profit. You have to know that this is an error. So the adjustment will have a prospective what? Effect. That is why we are subtracting from the other items. What will be the difference?
That's 476.
476. Okay. Okay, let me show the last way of doing it, then we move on. Okay. The last way is this one. You see that the closing balance for 2018. The closing balance for 2018 will be having a neutral effect on profit in 2019. The closing balance for 2018 will be having a neutral effect on profit in 2018. In 2019, rather, the gross profits carried down, the closing balance of 60 there, which is an overstatement, will be having a neutral effect on profit in 2019, the gross profit. Look at this. You can see that 60 was subtracted here, 60 was added. Can you see that?
Yes.
You can see that in actual sense, it's having a zero effect, isn't it?
Yes.
Come here. We added what? Tax of 18, and we subtract tax of 18. You can see that in actual sense, it's having a zero what? Effect. So another way of going about associate is that the closing inventory of 60 that was overstatement will become opening balance for 2019. So in actual sense, first it was treated as opening, and it's now treated as, it was first treated as closing, now it is treated as opening. So you can see that they will be having the same effect. Closing will be increasing profit, opening will be reducing profit. So the effect is zero. So you not do anything to the profit in the 2018. So you just have your 2019 here. Then you bring your opening balance. The 2019, you bring your opening balance of the profit for 2019. So the opening balance will be 240. Opening balance for 2019. The balance brought down for 2019 will be 240. Am I correct with that?
Yes.
Okay.
Yes.
The closing balance for 2018 will now become opening balance for this one. So you can put the 240 here. Okay. The 240 here, what you do is that you count your dividends. You count your dividends paid. Okay. The dividends paid will be 100. The dividend paid will be 100. Dividend paid will be 100. And the only thing that you are going to take into consideration will be the closing inventory, which is for 2019. That is the one that is going to affect the profit for 2019. So the closing inventory for 2019 was 70. It was 70. So the 70 will be subtracted from 385. Then you now find the tax implication on that. So you have your 385 minus 70 plus the tax implication on the 70. So I'll be having 385 minus 70 plus 21. I'm having 336. Is that correct? The 80 will not have effect. The 60 will also not have effect because the 60 will have the same effect. So the 60 was treated as closing. Now it's treated as opening. The effect will go. So the only thing that is going to affect the profit for this year will be that 70. So subtract the 70 from 385 and add the tax element of 21 to it. I'm having 336.
Yes, 336.
So the profit for the year will be 336. If you subtract, what are you getting? If you subtract and add, you will get your 476.
476.
Okay. So you accept the one that you like, but do the first one. The first one, since it's an error, it should have a prospective what? Effect. Since it's an error, it should have a prospective effect. So you adjust it, all of them for each year. Then you now also prepare your revised statement of profit or loss. Someone said that if we are done, he has a question. So I'm waiting for that question.
Go and buy phone to you.
Yeah, the person who's saying that he has a question. I want to attend to that question and go and put my laptop on charge. Or there's no question.
I don't think the person is still gone.
The person is gone. So the person should put the question in the group. Okay, HP. HP, your hand is up. Can you talk?
Yes, sir. It was, my question was with reference to the closing stock.
Okay.
I was thinking when the closing stock is overstated, it will reduce the profit.
No, please. Closing stock is subtracted from cost of sales. So if you are subtracting higher
Yes,
cost of sales,
available.
so it will make the cost of sales lower.
It will reduce the amount left to be taken from the revenue.
Yes.
Which
So
will increase the profit.
Yes, please. So that's why we are subtracting the closing stock. You should be able to subtract
so
200.
I was thinking because the profit is overstated, well, we will rather now, okay, okay. I was thinking if the amount left to be taken from, if the profit is reduced, then we will rather add it back instead of subtracting it.
No, the profit was already overstated with the overstatement of the inventory. This is the assumption. You have revenue of 500. The revenue was 500. Your cost of sales should have been 250.
Okay.
But you have subtracted 300. No, I should not make it 300. Your cost of sales should have been 200. Therefore, the closing inventory should have been 100. So that your cost of sales should have been 200. Okay?
Okay.
But you have subtracted 150 from your this one. It means that the cost of sales is going to be what?
Overstated. Okay.
The cost of sales is going to be understated, not overstated. Let me use accurate figures. Let me use assume figures. Our revenue was 500. Okay. Our cost of goods available, so coal gas, was 350. Okay. Our inventory, our closing inventory was 100. What should be our profit? Our profit should have been 500 minus 250, isn't it?
Definitely, sir.
Okay. So this would have been 250. Okay.
Yes.
We now realize that our inventory, our closing inventory should have been 80, not 100. Our closing inventory should have been 80, not 100. So in this case, our actual profit will now be 500 minus 270, and that will give us 230. So our actual profit should have been 230. But the profit that we reported was what, 250, because we overstated our inventory by 20. So since we are now having the 250, what do? We have to come and reduce it to the 230 now by subtracting the overstatement.
The 20.
Yeah.
Thank you, sir.
All right. Okay. I don't think we have any concern. I will see the corporate reporting people in the evening. The FR people, I will see you on Monday. Thank you all for coming. We shall meet when we meet.